All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick reminder: nothing in this video should be taken as investing advice. We talk about some highly risky investment ideas on this channel, so make sure to do your own work and always consult a professional before making any investment decision. So the topic of today's video is going to be Ginkgo Bioworks. Now, this is a small biotech company that we've talked about before on this channel as having some major red flags. In fact, back in March, we first released a detailed short report to our premium subscribers on the website differentiatedanalytics.com. At that point, the stock was trading at about $1.22. Now it's at just 76 cents. So that's worked out very well for us. So during the course of that time, Ginkgo Bioworks has just been getting worse and worse, and recently there's been some developments that seem to be seem like they might be the final nail in the coffin for this company. So with that, I'll kick it over to you, James, to talk about what's happened in the last few months with Ginkgo Bioworks that makes it so interesting compared to our previous videos.
Yeah, so we'll go through a very quick rundown of what Ginkgo Bioworks does, just in case anyone watching hasn't seen our previous videos about it. So Ginkgo Bioworks, they are a synthetic biology company, and they have two segments: cell engineering and biosecurity. The cell engineering, that's the main core part of the business. And what they do is they are a contract research organization where other companies will pay Ginkgo to develop some new type of organism, usually like an yeast cell that might have some, this genetically modified yeast cell that they create may have some useful properties for drug development, etc. So that's cell engineering. And then they have this second segment called biosecurity, which is mostly just during COVID. They opportunistically did a COVID testing business, and they generated a lot of revenue during the pandemic. As the pandemic, this biosecurity revenue has declined, almost to nothing. So the biosecurity is not really the core part of the business. It's just an opportunistic thing that they did during COVID. So the core business is the cell engineering. That's the synthetic biology that they do, making genetically modified organisms like cells, which are supposedly will be used for various industries and like drug discovery, etc. Now, one of the biggest one of the biggest bull cases of Ginkgo Bioworks historically was that they said when a customer comes to them asking Ginkgo to develop a new genetically modified cell, if that cell ends up resulting in a commercially successful product, Ginkgo will get a royalty, basically a percentage of whatever revenue is generated from the cell that they created. So Ginkgo Bioworks, the cell engineering, has two sources of revenue. When a customer wants Ginkgo to develop a new cell, there's an upfront payment that they have to give to Ginkgo. And then on the back end, there's this downstream value, which is a royalty in the event that Ginkgo is successful and develops a new cell that is indeed eventually commercialized. So in the Q1 2024 earnings release, they announced a new change to their revenue strategy. And here's what they said. We are changing commercial terms to remove friction in sales. Potential customers are typically excited about the scale of data we offer, but are deterred by our deal structures in IP and downstream value share. We are updating our deal structures as we seek to bring in customers at a faster rate. So the downstream value share, that's the royalties. And basically what they're saying here is that customers are no longer willing to work with Ginkgo because in the event that they successfully develop a new cell, the customer does not want to be required to indefinitely pay a royalty to Ginkgo Bioworks. So they're not really wanting to work with Ginkgo. And because people aren't wanting to work with Ginkgo, and as we can see on these blue bars, the cell engineering has been declining over the past year or so. So they're having trouble getting new customers. So now they're saying, okay, we're no longer going to ask for any royalties, and that's a more customer friendly um, proposition, and therefore they say that'll help them land more customers. But the problem is the downstream value, the royalties. That was basically the entire crux of the bull case for Ginkgo Bioworks that the management and the company has been telling to investors since they went public a couple of years ago. And the reason that is because when we try to analyze the profitability of the cell engineering segment, Ginkgo Bioworks does not disclose cost of goods sold for cell engineering, but substantially the vast majority of their research and development expense is effectively cost of goods sold for cell engineering because they're a contract research organization. When they are trying to develop a new cell on behalf of a customer, that expense is classified as research and development, but really that is the cost of them fulfilling the contract to the customer. So they technically call it research and development, but it's actually a good proxy for cost of goods sold given the nature of their business. And if we look here, the blue bars is the revenue that they generate from cell engineering in each of the last 3 years, as well as Q1 2024. And then the orange bar is their research and development expense during that same period. And you can see the research and development expense is massively greater than the revenue. But that research and development includes a lot of stock-based compensation, and especially because of the nature of how they did the SPAC transaction, there was like a bunch of employees got massive awards based on the completion of the SPAC. So in the first 2 years, in 2021 and 2022, there was these massive, I guess you could call them one-time stock-based compensation expenses uh, related to the SPAC, and that inflated the R&D expense. However, even if we exclude all stock-based compensation and only look at the cash research and development expense, then you get the gray bars. And the gray bars you can see are still massively greater than the revenue. So Ginkgo is researching to develop new cells on behalf of their customers, and their cost to research and develop these new cells is multiples greater than the revenue they get in return. So if we just look at the first quarter of 2024, research and development expense was 403% of cell engineering revenue. If you exclude stock-based compensation, it was still 316%. So this business is extremely unprofitable. But historically, Ginkgo has said that maybe we're not profitable now, but eventually we're going to get all these royalties when we successfully develop these cells, and eventually those royalties will add a bunch of revenue, and that will eventually make us profitable. And here is something from their 2021 SPAC presentation where they showed where Ginkgo provided an illustrative valuation of how much they think they'll be worth in 2025. Now, this is these numbers are based on their projections, which were complete BS. For example, they said that they predicted they would be making $628 million of cell engineering revenue in 2024. Based on their Q1 run rate, they're only going to make about $150 million of cell engineering revenue in 2024. So they're massively missing their projections. But the reason I bring this slide up is because they explain in their illustrative valuation how much they think the downstream value should be worth. And according to them, by 2025, or I guess by 2024 here actually, uh, they say that the cell engineering business would be worth $11 billion based on a price to sales multiple they applied to it. And then they said by 2025, the present value of their downstream revenue, their downstream value opportunities would be $25 billion. So if you add those two numbers up, you get $36 billion is their illustrative valuation, which they expect to be worth by 2025. And of that $36 billion, 25 billion is from the downstream value. So, according to their own illustrative valuations, the downstream value should represent more than 2/3 of the company's total value. So that's going back to what I was saying, that the downstream value, these royalties that they were expecting to receive, represents basically the entire bull case of the company. Yet now they're saying, customers aren't willing to give them royalties, so that entire bull case is just wiped out. So why is this happening? Um, Here's CEO Jason Kelly, who explaining why this is happening on the Q1 earnings conference call. And it's important to remember that Jason Kelly, this guy here, he was a co-founder of Ginkgo Bioworks all the way back in 2008. And he's been working at the company since 2008, and he's been the CEO of the company. I'm not sure when exactly he became CEO, but he's been the CEO for many years. So he's been running this company for many years, and now they're completely changing their strategy. So what is his explanation? So this is what he said. And now look, I designed a lot of these service terms, right? I was responsible for our business model at Ginkgo, and I battle tested it. I'm out there talking to customers every week, and it varies a little by market. So, for example, in biopharma, there's a lot of tolerance for milestones and royalties, blah, blah, blah. But then in industrial biotech, like chemical industries where margins are lower, they hate it. So one size fits all is not a great idea. And then, secondly, in biopharma, there's much more sensitive to intellectual property. So, given how much it makes up the competitive moats around a drug, so they have a lot of sensitivity to that section. You're going to reuse some of this data, then I'll pay for it to potentially bring to a customer. This creates resistance in deals. So, when you see us adding all these new programs, know that we're fighting through that resistance with customers to get them done. And we felt that was important. And I think in the context of where we are today and the rate of revenue I'm seeing and what I'm hearing from customers, we should change it. And so I'm going to stop fighting customers on these things, update our terms to give customer IP reuse rights, and in many cases, not include downstream value share. There will be some exceptions, but by and large, we will remove that downstream value share. And our hope is this will speed up deal making as we spend huge amounts of time negotiating these IP terms. So basically, what he's saying is that in the past, for many years, they've always been trying to get customers to give up the intellectual property rights of the cells that they're developing, as well as do these downstream value share, which is the royalties. But because customers are so resistant to doing this, he's finally decided that this is a bad idea. But if this is the case, Jason Kelly has been a co-founder of Ginkgo Bioworks since 2008. So what is that? That's almost 16 years now. So it's been 16 years that Ginkgo Bioworks has been trying to get these downstream value shares and also trying to take the IP rights of the cells they develop. But just now, 16 years later, he's finally figuring out that customers don't want to do this and this is an unviable strategy. So that's, kind of a huge red flag. Why is this sudden change in strategy just happening now? And I think as we dig in a little deeper, we might be able to speculate as to the real cause. So, as we talked about earlier in the SPAC presentation, Ginkgo Bioworks was massively hyping up their potential to receive downstream revenue royalties, downstream royalties as part of their downstream value in the future. And if we look at this, is from a recent investor presentation. this here is actually their Q4 2023 investor presentation. They talk about their milestone pool opportunity. And what this is they look at all of the projects that they're working on behalf of customers, and they look at these and they try to estimate how much royalties they will eventually receive from these projects when and if these cells that they're working on are eventually commercialized, be it in a new drug or whatever. And interestingly, if you look at this graph, as of 2020, they only had $5 million of potential milestone opportunities. So by 2020, Ginkgo Bioworks was already a 12-year-old company. And in the first 12 years, they were only able to accumulate $5 million of potential milestones. Yet then, in 1 year, in 2021, they get $200 million of potential milestones. So how is it the case that in the first 12 years, they only get a minuscule amounts of these potential milestones, yet then in 2021, they magically get $200 million of potential milestones? Well, it could just be a coincidence, but 2021 was also the year that they did their SPAC transaction, and they needed to show this massive milestone opportunity in order to convince investors to buy into the SPAC. So that's my speculation. The timing is very coincidental. And then after they go public in 2022 and 2023, their revenue for cell engineering is massively underperforming expectations and underperforming their projections. But while they're not having revenue, they're at least showing that their pool of milestone opportunities is massively increasing. It went up all the way to $2.4 billion by the end of 2023. So at least this is a way of Ginkgo to tell investors, well, we're not generating that much revenue yet, but just give us some time, and we're eventually going to realize these $2.4 billion worth of milestones. The problem is these potential milestone opportunities have not been playing out. So in this chart on the right, it shows how much downstream revenue they generated each year. So they indeed generated about 26 million of downstream revenue in 2021, and then they generated like 38 million of downstream revenue in 2022. In 2022, the majority of this downstream revenue was related to a synthetic THC thing that they created for the Kronos group to make a synthetic THC gummy bear. That THC gummy bear was a huge flop, and Kronos actually had to take an impairment charge because the sales of this gummy bear were so disappointing. So the point I was trying to make there is that they their projects for customers haven't really been working out that well. Even when they have gotten some downstream revenue, that's not necessarily because the product ended up working out for the customer. It's just that because the product was indeed commercialized, they were able to recognize some revenue. And then in 2023, they only had less than $5 million of downstream revenue. But even at the peak in 2022, when they had this Kronos gummy bear, the 38 million of downstream revenue is only a tiny fraction of this, $2.4 billion of milestones, of potential milestones that they're talking about. So obviously, they're having a huge amount of difficulty ever realizing these potential milestones as real revenue, which could lead many investors to believe that these potential milestone opportunities are just complete BS that they're putting out there to, in order to basically paint a rosier picture than is the reality. And over time, as time goes on and they continue, claiming to have this massive pool of potential milestones, yet these milestones are never realized to anything like the extent that that Ginkgo Bioworks would lead you to expect. Eventually, investors are going to realize that this whole thing is just smoke and mirrors, and these milestones are never going to happen. So I believe this is why Ginkgo Bioworks is just now coming out and saying, "Oh, we're not going to do these milestones anymore is because now that it's been a few years since they went public and this downstream revenue still is not materializing, eventually investors are going to, catch on to their charade. And so they're trying to preempt that by saying, okay, we're proactively going to, stop doing these downstream revenue and stop talking about it. So I think really this is basically Ginkgo Bioworks admitting by doing this change, Ginkgo Bioworks is admitting that this whole downstream revenue thing was basically complete BS. So we talked about how Ginkgo Bioworks is losing a huge amount of money, and the upfront payment that they receive from their customers to do the research and development is not nearly enough to cover their own costs of research and development. So Ginkgo just announced that they will be doing a massive cost reduction in order to try to achieve profitability. And they say that they expect to achieve $100 million of annualized reduction in operating costs by the end of this year, and a $200 million reduction in annualized operating costs by the middle of 2025. And they say that they're going to deconsolidate their global footprint. So that means selling or ending leases on some of their facilities. And then they're going to do a 25% reduction in labor. So that, presumably means that they will be laying off 25% of their staff. And then they will eliminate some discretionary spending. So how are they going to achieve these cost cuts? And will this be enough to bring them to profitability? So on the first issue of the cost cuts, so they say that they are, decreasing their facilities footprint and reducing labor costs by doing layoffs. And they say the reason they're able to do this, or one of the reasons they're able to do this, is because they are building a new. Well, they're going to move their core operations to a new facility. So currently, they have a very large facility where they do all their cell engineering work. They're going to this year move into a new facility that's much smaller. Here's a CGI rendering of it. So I guess they're presumably going to build this smaller facility, which will be cheaper to operate. And they say they have this new technology, what they call, what do they call it? They called, I think, a rack-based. It's like a rack-based automated cart, and it's this automated piece of lab equipment that they say is way more efficient than what they previously used, and that will help them to reduce labor costs. So they say, okay, we're going to move to this smaller facility and use this more efficient lab equipment with automation, and that's going to help us reduce costs. But if we go back to the 2021 SPAC presentation, at the time, they already claimed to be using a ton of machinery and a ton of automation. And according to their own claims, they said that their cost to engineer each cell decreases by 50% per year. So according to them, as they install a new high-tech machinery and increase their scale, the cost to engineer each cell will be decreasing 50% per year. Well, obviously that has not played out, because if that were the case, they wouldn't be losing so much money now. And then so, they previously claimed that their cost per cell is decreasing 50% per year. And this obviously has not happened, has not played out. And then now they expect us to believe that, they bought some new machine and then that's going to somehow solve all their problems. But why would we believe them when they've disastrously failed on all of their previous projections? And then, so let's just say that, take their word for it and say that they will indeed cut $200 million of annualized operating costs. So this is annualized. So $200 million of operating costs per year would be $50 million per quarter. So that means that they're going to decrease their operating expense by 50%, $50 million per quarter. So we can look at their Q1 2024 financial results and then see whether or not this would get them to profitability. So in the first quarter, they made $38 million of revenue. 28 million of that was from cell engineering, and then $10 million was from biosecurity. Remember, biosecurity was mostly the COVID testing business that has basically dried up, and now they do, testing for some other diseases and whatnot. But it's a pretty it's a it's a lot less revenue than it was during COVID, but it's still something at $10 million. But anyway, so they had $38 million of revenue, total revenue in the first quarter of 2024. The cost of revenue for biosecurity was $9 million. And again, they do not disclose cost of revenue for cell engineering, but it's basically research and development, which was $112 million. And then they had $52 million of general and administrative costs, and then $42 million of stock-based compensation. So their total operating expenses in the quarter was $215 million, and that gave them an operating loss of $178 million. So they lost $178 million in the first quarter. If we divide that by revenue, that gives them an operating margin of negative 469%. Now, uh, Ginkgo Bioworks likes to talk about their adjusted EBITDA, which excludes stock-based compensation. So let's just give them, the benefit and exclude stock-based compensation. Well, if we exclude that $42 million, their operating loss would have only been $135 million, but that's still 357%, negative 357% operating margin, which is extremely bad. Now, so let's apply these $50 million of cost cuts. So what I did is I took research and development expense, subtracted $25 million from that, took general and administrative expense, subtract $25 million from that. So in total, we have a $50 million reduction in costs. Their operating margin would be negative 337%. Excluding stock-based compensation, their operating margin would be negative 225%. So even if they can achieve this 200 million of cost cuts, they're still going to be extremely unprofitable. And then now let's look at their financial position. As of the end of the first quarter, they had $840 million of cash on hand. In the first quarter, they burned about $100 million. So on that run rate, they burn about $400 million worth of cash per year. Now, they claim that that rate of cash burn will decrease because of their cost cuts. But let's just use these numbers. Let's just use the current run rate of cash burn for illustrative purposes. So at $100 million of cash burn per quarter, they'll be burning about $400 million per year. And they will burn through all of their cash within a little over 2 years. Another thing to consider is that the Ginkgo Bioworks share count has increased by 29% since they went public due to equity raises that they've done, very high stock-based compensation, and also they've done some small acquisitions, which they've paid for in stock. So, as they run out of cash over the next couple of years, they are going to have to do, they're most likely going to have to do even more dilutive equity raises. And then this rate of dilution could accelerate even further. Now, one thing I think a lot of investors maybe misunderstand is that when you see a stock like Ginkgo Bioworks and see that the share price is down 92% since it went public, you might think, oh, well, it's the stock is down a lot, therefore it must be cheap. It's like when you go and if you walk into the store and you see a piece of a piece of clothing that's marked down as a 92% discount, you might think, oh, that's a bargain. It's a good value I'm getting. Well, the thing is with stocks, you can't just look at the fact that it's down a lot and then think that it's a cheap stock. You have to look at, how much revenue is it actually generating versus what is its market cap. It doesn't matter, what was the historical share price action. We just have to look at what is the valuation today versus how much revenue they're generating. And if we look at Ginkgo Bioworks, their fully diluted market cap, including their restricted stock units, is about $1.75 billion. And then they have 840, then we subtract the $840 million of cash they have on hand. So the enterprise value of the company is about $900 million. Based on the first quarter run rate, they're making annual revenue of about $150 million per year. And if we divide the enterprise value by that revenue run rate, their valuation is about 6 times enterprise value to sales. And that enterprise value will increase over time as they burn cash and issue new shares for stock-based compensation. And if and when they do equity raises, which they probably will over the next couple of years. So it's 6 times enterprise value, and that enterprise value is likely going to increase. As a comparison, Amazon is 3.4 times enterprise value to sales. Amazon is profitable and its revenue is growing. Ginkgo Bioworks is burning cash and its revenue is shrinking. So just comparing those two stocks, if you looked at a chart of Amazon over the past 5 years versus a chart of Ginkgo over the past 5 years, just looking at the chart, you might think, oh, maybe Ginkgo is the better bargain because the stock is down a lot. But if we actually look at the revenue and enterprise value, Ginkgo is actually more expensive, despite the fact that it is burning cash and its revenue is declining. So all things considered, Ginkgo is, completely a failed company in my opinion. If we look at, the quarterly revenue, the revenue has been declining over the past couple of years, and they're losing money. And they've basically now admitted that the whole bull case of downstream value is not going to happen. So I really don't see any reason how anybody should be. I really don't see any way that this company can work out favorably when basically everything is going so disastrously for them.
The point about them changing up their deal structures, right? That can't help but be reminded of at least a couple of examples of other SPAC type companies. And I won't say any names, but at least a couple of examples of these SPAC type companies that when they go public, they make these promises to investors at the time that they do their de-SPAC, and then after a couple of years or however long, relatively short period of time, they kind of get to the end of the line in terms of delivering on these promises, and they conveniently kind of either they say they've pivoted some part of their business strategy or made some other change that conveniently makes their delivering on those original promises not valid anymore, right? So and that in those examples, it's never really worked out for the companies in the long run as an indicator for how the success they have in the future. So I just want to say that kind of reminded me of a couple of those examples that Ginkgo seems to be doing the same type of thing.
Yeah, exactly. Like when they do the SPAC and they have they have one business strategy that they claim that they're going to execute on, and their claim is going to be a huge success. And they make these massive revenue projections saying, in the case of Ginkgo, saying, oh, we're going to make $25 billion of downstream value. And then a couple of years later, it hasn't worked out. And they say, oh, no, we're not doing downstream value anymore. Well, then if you were so disastrously wrong and your forecast was so disastrously wrong last time, why should anybody give you a second chance, right?
Especially to your last point about the company being so expensive based on these, based on EV to sales or whatever other metric you want to look at, based on these projections, right? It just doesn't make any sense to an investor.
Yeah. So I think that's basically everything we had to talk about Ginkgo Bioworks. So as always, if anybody has any opinions or thoughts on Ginkgo, please let us know in the comments section below, and we will sign out and see you all on next week's video.